Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by my company, Bull Realty, Asset and Occupancy Solutions. Visit bullrealty.com. Today we're talking retail real estate. My guest is Jim Costello. He's Senior VP with Real Capital Analytics. And Jim, we were talking about the market, the cap rates, what you're seeing in retail investment real estate. I think one of the questions that is on the mind of a lot of people today is the cycle. It seems like we've had good times for a long time. Where are we in the cycle, especially when it comes to retail real estate?
Yeah, where are we in the cycle is a huge question that everybody worries. And normally when they're asking the question, they've got this notion that the market's a roller coaster, that you get to the top and then you naturally have a crash and everything falls to record lows. I think that kind of pattern of behavior is not necessarily going to be the same this time as in previous cycles. There's things that rhyme in every cycle, but every cycle has its unique characteristics. Here's the funny thing. At some point, I became the older guy in the room, and a lot of the folks I'm working with now, when they talk about the last downturn, the only downturn they've seen is what we went through in the global financial crisis. And so they think that, anytime there's a downturn, that's what you go through. But I remember the 2001 downturn, and before that, the 80s downturn, there were some elements that were just as bad. There were some elements that were better. If we have a downturn sometime in the next few years, it'll have its own unique characteristics, different from every other one.
Yeah, I think you're right. I mean, we know there's always going to be a cycle, but how long the cycles are and how far they go up or down is always going to be different. And I agree. It seems like there's a lot of elements to commercial real estate that we don't have as a problem that we had in the last one. And you mentioned the 86 downturn or the 80s downturn, and I think some of that was from the tax law changes that we had, changing depreciation at the end of 1986, and S&Ls failed. There was some big changes, and of course we're looking at tax reform now. There's been some talk of maybe altering or repealing the 1031 exchange. So what impact do you think these contemplated tax changes could have on commercial real estate values?
Yeah, I tell you, the tax stuff that's being talked about, it's very tricky because the challenge is that nobody quite knows exactly what's going to happen. And if any one thing happens that we've been looking at, it could be bad. There's a few other things, though, that could be beneficial. The Real Estate Roundtable has come out and said if all the tax proposals that are out there come together at once, the total effect should be neutral on real estate, because while there's certain benefits we will lose, we will have a lower overall tax rate, and that will make up for it. But the devil's in the details. It can sound great on paper, but then when it starts to impact the balance sheet, a little movement can sometimes have a big impact when you're talking about some percentage rates and the ability to depreciate and how tax structures come about. So it's something, it's a risk, and there are potential changes to the market that we have to worry about. Sadly, it's all unclear at the moment because we don't quite know what mix of policies is going to happen.
Yeah, that's a good point. It's the jury's still out on that, and but one thing the jury's not out on, Jim, is that interest rates have been really low, and that if the market continues to improve, and we hope it does, the economy, that interest rates will rise. So what do you expect the impact to be on commercial real estate sales and cap rates and values, and especially maybe related to retail?
Yeah, this is a mixed bag. If you think about interest rates, if the economy is growing and there's competition for capital and companies are investing, that's something that frankly should be a beneficial driver for property overall, because then you can have better tenants and faster growing rent. So that could offset any interest rate increases to some degree. The interest rate increase I'm starting to be concerned about is what happens next with the Fed balance sheet unwinding. They've talked about starting to sell $10 billion a month of primarily mortgage instruments that they're currently holding. You think about the capital that's coming to the commercial real estate world, a lot of it is this fixed income capital that's looking for a safe, stable yield. That mortgage stuff that the Fed is holding is going to look very attractive to those folks. Right now, our market, the commercial real estate market in the United States, is roughly $30 billion a month in terms of scale. That's about what the Fed says that they're going to try and sell eventually from their portfolio. So, that I think may have some challenges in the sense that there's a lot of capital still looking to get into the fixed income world of commercial real estate. But do we start seeing competition for that capital as the Fed starts selling off assets from its balance sheet?
All right. So how might that impact some of the listeners that own shopping centers around the U.S.?
The way it impacts you, suddenly, if you want to sell that shopping center, maybe there's fewer potential bidders because they're at the prices that you want, because those investors may have other options now in terms of buying fixed income securities from the Fed. Tied to real estate.
Yeah, that's interesting. And then a final thought from you, Jim, foreign investment. It seems like a lot of foreign investment has continued to improve in the U.S. There's been more interest. It's considered a safe haven. Our tax law changes, what's going on in the world. What do you expect moving forward for foreign investment in U.S. real estate, particularly retail, and the impact moving forward?
Cross-border investment, it's what we've seen so far in 2017. It's actually down from where it had been last year and the year before. It's still at an elevated level relative to history, and the cross-border investors, despite all the negative headlines flying around in the United States right now, these portfolio investors, sitting back in Zurich and Abu Dhabi and Beijing, they look at the United States and they think, that is a productive economy, high income earners. It's a place that I want to have some exposure to. Now the pace is down because prices are high, and they're always looking for opportunities themselves. And all institutional buyers are starting to pull back a bit because it's hard to get the kind of IRRs you need out of your real estate portfolio when you have to pay record low cap rates for an asset.
Right. Yeah, that's true. And I think hopefully U.S. is a safe investment for us investing here in the U.S. and for our foreign investors. And Jim, thanks for joining us today. We appreciate your insight.
Thank you much.
And thank you for joining us out there. Stay tuned. We're going to have more on retail real estate. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.